Well, the asset class has certainly come into the spotlight, Christian and Chris. I have to ask, why now? Why should investors be excited about investing in specialty finance?
Oh, Priam, it is an exciting time right now it's a confluence of a number of different reasons. I would highlight two important ones. One is higher rates and what it's doing to banks. So banks, the days of banks being able to depend on zero cost of deposits, those are over. And especially a second-tier regional bank that is less creditworthy really does need to worry about its access to deposits. And so it's changing its business model away from originating these loans to hold in its balance sheet to find ways to sell them out to the PIMCOs of the world. So that's the one thing that rates is doing. The other thing that rates is doing is it's really threatening the direct lending corporate private credit market, where those are floating rate loans on levered borrowers that are very exposed to higher interest rates and the additional interest costs that they're incurring. And so now is the time really to diversify away from that area, especially on if you have legacy claims, to look at more of other asset classes that may be less interest sensitive.
I would add, I think where we're at today, I think the consumer overall is in very good shape. The starting conditions are much better. There's an opportunity, given the volatility that Christian just referred to from the rate side, to create some very attractive entry points. We're seeing less competition from where we were several years ago. I think the rate volatility has reshaped the landscape, not only in terms of what's happened with the regional banks, but also in terms of the non-bank originators that were a large player in these markets a couple of years ago. So we're finding opportunities, as I said. We like where the consumer's at from a health perspective going forward, and we're able to go up in credit. So we think it's a very target-rich environment right now.